Right now, as you're watching this video, trillions of dollars are moving around the world. But here's something that might shock you. Most of those dollars don't actually exist as physical cash. They're digital entries in computer systems, backed by nothing more than trust and agreement. The US dollar has been the world's dominant currency for over 80 years, but what actually keeps it working? And more importantly, what happens when that system starts to crack? By the end of this video, you'll understand exactly how the dollar maintains its power and why its stability affects everything from your grocery bill to global wars. If you want to understand the real forces shaping your financial future, hit that subscribe button and let's dive in. Before we talk about why dollar stability matters, we need to understand something fundamental. The dollar isn't backed by gold anymore. It hasn't been since 1971. So what gives it value? The answer is more fascinating and more fragile than most people realize. The US dollar operates on what economists call a fiat system, which literally means by decree in Latin. In other words, the dollar has value because the government says it does, and more importantly, because people believe it does. But that's just the surface level. Think about this for a moment. You wake up, buy coffee with dollars, pay your rent in dollars, and your employer pays you in dollars. You probably don't question whether those dollars will be worth the same tomorrow. That automatic trust is the invisible force that keeps the entire system running. But throughout history, that trust has been broken again and again in country after country. Germany in the 1920s, Zimbabwe in the 2000s, Venezuela just a few years ago. When currency trust breaks, societies don't just experience economic problems, they experience complete social upheaval. The United States dollar is different, though. At least that's what we've been told. It's the world's reserve currency, meaning other countries hold dollars in their reserves and conduct international trade in dollars. When Japan buys oil from Saudi Arabia, they typically use dollars, not yen or reals. When a Brazilian company imports machinery from Germany, the transaction often happens in dollars. This creates constant global demand for the currency, which helps maintain its value. But this system wasn't always in place, and there's no guarantee it will last forever. Let's go back to 1944. World War II is still raging, but the Allied powers are already thinking about what comes next. They gather at Bretton Woods, New Hampshire, for a conference that would reshape the global financial system. The US emerges from the war as the world's largest creditor nation, holding most of the world's gold reserves. Other countries' economies are devastated. America's industrial capacity is intact and booming. The Bretton Woods Agreement established the dollar as the world's reserve currency, backed by gold at a fixed rate of $35 per ounce. Other currencies were then pegged to the dollar. This meant that if you held dollars, you were essentially holding gold, because you could theoretically exchange those dollars for gold at any time. The system worked for a while, but it had a fatal flaw. Here's what history shows. America started spending more than it had. The Vietnam War, domestic social programs, and rising inflation put pressure on the system. Other countries, particularly France under Charles de Gaulle, started demanding gold for their dollars, and the US gold reserves began draining away. By 1971, President Richard Nixon faced a choice: either dramatically cut spending and raise interest rates, causing a severe recession, or abandon the gold standard entirely. On August 15, 1971, Nixon made what he called a temporary suspension of dollar convertibility to gold. That temporary suspension has lasted over 50 years now. This moment, often called the Nixon shock, fundamentally changed what money means. From that point forward, the dollar's value would float based on supply, demand, and most crucially, confidence in the US government's ability to manage its economy. So if the dollar isn't backed by gold, what backs it? The answer involves three interconnected pillars: the productive capacity of the American economy, the military power of the United States, and the institutional framework that includes the Federal Reserve and the banking system. Let's break this down in simple terms. The Federal Reserve, America's central bank, has the power to create dollars essentially out of thin air. When the government needs money beyond what it collects in taxes, it issues treasury bonds. The Federal Reserve can purchase these bonds by creating new money electronically. This new money enters the banking system, where commercial banks can lend it out multiple times through a process called fractional reserve banking. Here's a simple example of how this works. Imagine you deposit $1,000 in your bank. The bank is only required to keep a small fraction, let's say 10%, as reserves. That means they can lend out $900 to someone else. That person spends the $900, which gets deposited in another bank, which can then lend out $810 and so on. Your original $1,000 deposit can multiply into several $1,000s moving through the economy. This is how most money is created, not by printing presses, but by lending. This system works beautifully when everyone trusts that their deposits are safe and that dollars tomorrow will be worth roughly the same as dollars today. But notice how much depends on trust and belief. If people suddenly lose confidence and start pulling money out of banks, the system can freeze up. We saw glimpses of this during the 2008 financial crisis, and again in 2023 with Silicon Valley Bank's collapse. The dollar's stability also depends on something less tangible but equally important, network effects. Because so much international trade happens in dollars, countries need to hold dollar reserves. To get those reserves, they need to either sell goods to America or attract investment from American investors. This creates constant demand for the currency. Oil, the world's most traded commodity, is primarily priced in dollars. This petrodollar system means that any country buying oil needs dollars to do so, creating built-in global demand. Did you know that roughly 60% of global foreign exchange reserves are held in US dollars? The next closest currency, the euro, accounts for only about 20%. This dominance creates a self-reinforcing cycle. Because everyone uses dollars, everyone wants to hold dollars, which makes the dollar more valuable, which makes everyone want to use it more. But history teaches us that no dominant currency stays dominant forever. The British pound sterling once held the position the dollar holds now. Before that, it was the Spanish real, and before that, various other currencies throughout history. When a currency is stable, you barely notice it's there. You make plans, sign contracts, save for retirement, and take out mortgages, all assuming that the dollars you're dealing with will maintain relatively consistent purchasing power. Businesses make long-term investments. International partners engage in trade deals spanning years or decades. This predictability is the foundation of modern economic life. But when currency stability breaks down, everything changes. Imagine planning for retirement, carefully saving for 30 years, only to discover your savings lost 80% of their purchasing power in a single year. This isn't a hypothetical scenario. It's happened repeatedly throughout history, and it's happening right now in various countries around the world. Currency instability creates a cascade of problems. First, people lose faith in saving, because saving means watching your money lose value. This shifts behavior toward immediate consumption or alternative stores of value like gold, real estate, or foreign currencies. Second, long-term planning becomes nearly impossible. Why would a business invest in a factory that takes 5 years to build if they can't predict what costs or revenues will look like in 5 years? Third, social contracts break down. Retirees on fixed incomes see their purchasing power evaporate. Workers demand higher wages to keep pace with rising prices, which pushes prices even higher in a wage price spiral. The United States has experienced relatively stable currency conditions for most of its modern history, with some notable exceptions. The 1970s saw inflation reach double digits, causing significant economic disruption. Interest rates on mortgages exceeded 18% at one point. More recently, the rapid money creation during the COVID-19 pandemic, followed by supply chain disruptions, led to inflation rates not seen in 40 years. Your grocery bill probably reminded you of this reality. This video is for educational purposes only and does not constitute financial advice. What we're exploring here are historical patterns and economic mechanisms, not predictions or recommendations. Here's what makes the dollar's stability so critical. It's not just an American issue. Because the dollar serves as the world's reserve currency, dollar instability creates global instability. When the Federal Reserve raises interest rates to fight inflation, it affects borrowing costs in countries around the world. Developing nations that borrowed in dollars suddenly face higher debt service costs. Currency crises in emerging markets often trace back to dollar strength or weakness. Now that you understand how the dollar system works, let's talk about something more unsettling. How to recognize when it's starting to fail. Currency collapse doesn't happen overnight. It's not like a light switch that suddenly turns off. Instead, it's more like a slow leak in a tire. At first, you barely notice anything wrong. The car drives fine. But if you ignore the warning signs, eventually you're stranded on the side of the road. Throughout history, currencies that eventually collapsed showed remarkably similar warning patterns. And here's what should concern you. Several of these patterns are visible in the United States right now. Before you think this is alarmist, remember that recognizing patterns isn't the same as predicting outcomes. It's about understanding risk and preparing accordingly. The first warning sign is always the same. Rising government debt relative to the economy, its ability to repay it. Think of it like a household. If you earn $50,000 a year and you owe $60,000, that's manageable. You can pay it off over time. But if you owe $500,000 with that same income, you have a serious problem. For countries, we measure this as the debt to GDP ratio, which compares total government debt to the size of the entire economy. The United States currently carries over $36 trillion in federal debt, with a debt to GDP ratio exceeding 120%. For context, that's higher than it was after World War II, when the country had just financed the most expensive military conflict in history. But here's the critical difference. After World War II, America had virtually no economic competition, massive manufacturing capacity, and decades of strong growth ahead. The debt was paid down as the economy grew. Today's situation is different. The debt keeps growing faster than the economy, and there's no clear path to reversing this trend without painful choices. Have you ever wondered why this matters so much? Because at some point, investors who lend money to the government by buying treasury bonds start questioning whether they'll be repaid in dollars that hold their value. When that doubt creeps in, they demand higher interest rates as compensation for the risk. Higher interest rates mean the government must spend more just to service existing debt, which often leads to borrowing even more, creating a vicious cycle. The second warning sign is monetary expansion that outpaces economic growth. In simple terms, this means creating new money faster than you're creating new goods and services. The money supply in the United States has expanded dramatically over the past 15 years. During the 2008 financial crisis, the Federal Reserve implemented quantitative easing, essentially creating trillions of dollars to purchase bonds and support the financial system. Then came the pandemic response, which involved even more money creation on an unprecedented scale. Here's a fact that might surprise you. In 2020 and 2021 alone, roughly 40% of all dollars in existence were created. Let that sink in for a moment. Nearly half of all the dollars that have ever existed were created in just 2 years. Now, the economy didn't grow by 40% during that period, not even close. This is the classic setup for inflation, and sure enough, that's exactly what followed. Let's look at historical examples, because they reveal patterns that repeat with eerie consistency. Germany's Weimar Republic offers the most famous case study in currency collapse, and the lessons remain relevant today. After World War I, Germany owed massive reparations to the Allied powers. The government couldn't collect enough taxes to cover these payments, so it started printing money. At first, this seemed to work. The extra money stimulated the economy, unemployment dropped, and people felt wealthier. Politicians celebrated their economic management skills, but they had unleashed forces they couldn't control. By 1923, the situation had spiraled completely out of control. Prices doubled every few days. Workers demanded to be paid twice daily so they could rush out and buy goods before prices rose again. People carried wheelbarrows full of cash to buy bread. Life savings became worthless overnight. A German who had saved diligently for retirement found their entire nest egg couldn't buy a single loaf of bread. The middle class was essentially wiped out, creating social conditions that contributed to the rise of extremism and eventually World War II. But here's what most people miss about the Weimar story. It didn't happen all at once. There were years of warning signs, debt kept rising. The government kept promising the money printing was temporary and necessary. Experts assured the public that modern monetary management meant the old rules no longer applied. Sound familiar? Let's jump forward to a more recent example, Venezuela. In the early 2000s, Venezuela was relatively prosperous, with the world's largest proven oil reserves. The government, under Hugo Chavez and later Nicolas Maduro, began spending far beyond its means on social programs. When oil prices were high, this worked, but they made the fatal mistake of believing high oil prices would last forever. When oil prices collapsed in 2014, Venezuela's government revenue plummeted. But instead of cutting spending, they printed money to cover the gap. They assured citizens this was temporary. They blamed external enemies and speculators for economic problems. The pattern should sound familiar by now. By 2018, Venezuela's inflation rate exceeded 1 million%. 1 million%. A cup of coffee that cost 450 bolivars in 2016 cost 1 million bolivars in 2018, and then 2.5 million bolivars by 2019. People's life savings evaporated. The country experienced mass immigration, with over 7 million people fleeing. Store shelves emptied, crime soared. A once prosperous nation descended into economic chaos. Did you know that Venezuela's currency collapse happened in a country with more oil than Saudi Arabia? This demonstrates a crucial lesson. Natural resources and wealth don't protect you from currency collapse if you mismanage your monetary system. Zimbabwe offers another stark example. In the early 2000s, President Robert Mugabe's government seized commercial farms in a land reform program that destroyed the country's agricultural productivity. Government revenue collapsed, but spending continued. The solution? Print money. By 2008, Zimbabwe had printed a $100 trillion banknote. That's not a typo, 100 trillion. And that banknote couldn't buy a bus ticket. The country eventually abandoned its currency entirely and started using US dollars and South African rand. So what actually triggers the transition from manageable problems to full-blown currency crisis? History shows several common triggers that appear repeatedly. The first trigger is loss of confidence by foreign holders of the currency. Remember, the dollar's strength depends partly on global demand. Countries and investors around the world hold roughly $7 trillion in US Treasury bonds. What happens if they decide they no longer want to hold these bonds? They sell them, which drives down bond prices and drives up interest rates, which makes the government's debt burden even heavier. We're seeing early signs of this shift. China has been gradually reducing its holdings of US Treasury bonds. Russia largely abandoned dollar reserves after 2014. More recently, countries like Brazil, India, and others have been negotiating trade deals in their own currencies rather than dollars. Saudi Arabia, which has priced oil in dollars since 1974, has been discussing accepting other currencies for oil sales. Each of these moves is small individually, but collectively they represent cracks in the petrodollar system. The second trigger is fiscal crisis. This happens when government spending so exceeds revenue that the gap becomes unsustainable. The United States currently runs trillion-dollar annual deficits during times of supposed economic growth. What happens during the next recession? When tax revenues fall and spending on unemployment and other programs automatically increases, the deficit could easily double or triple. Here's where it gets tricky. The government has three choices when facing a fiscal crisis. First, it can raise taxes, but there are political and economic limits to how much taxes can increase. Second, it can cut spending, but again, political resistance makes this extraordinarily difficult, especially for large programs like Social Security and Medicare. Third, it can inflate the debt away by creating money, which is the path most governments eventually choose because it's politically easier. But this third option is exactly what leads to currency devaluation. The third trigger is external shock. Wars, pandemics, natural disasters, or financial crises can rapidly accelerate currency problems. The COVID-19 pandemic demonstrated how quickly governments will abandon fiscal restraint during emergencies. The response was probably necessary to prevent economic collapse, but it came with long-term costs that we're still discovering. A war that disrupts global trade or requires massive military spending could similarly force rapid monetary expansion. Climate-related disasters that require massive reconstruction spending could trigger similar dynamics. The point isn't to fear these events, but to recognize that the margin for error is shrinking as debt levels rise. Let's talk about the most insidious pattern, the debt spiral. This is how countries with reserve currencies typically experience decline, and it's different from the hyperinflation scenarios most people imagine. Here's how it works. As debt grows, the government must pay more interest on that debt. In the United States, interest on the national debt now exceeds $1 trillion per year, making it one of the largest federal expenses, comparable to defense spending. As interest rates rise, this number grows rapidly. More spending on interest means less money available for other programs, which creates political pressure to either raise taxes or borrow more. Usually, governments choose to borrow more. But here's the trap. As you borrow more, investors demand higher interest rates to compensate for increased risk. Higher interest rates make your debt burden heavier, forcing you to borrow even more. You can see the spiral forming. At some point, you reach a critical threshold where the market loses confidence that you can ever repay the debt without inflating it away. Japan offers an interesting case study in how long this process can continue. Japan's debt-to-GDP ratio exceeds 260%, more than double the US level. Yet Japan hasn't experienced a currency crisis. Why? Because most Japanese debt is held domestically by Japanese citizens and institutions who have continued buying government bonds despite minimal returns. Japan also runs a trade surplus and has substantial overseas assets. But Japan's situation also demonstrates the long-term cost of this approach. Decades of minimal economic growth, an aging population, and zombie banks and companies kept alive by cheap money. Japan avoided a dramatic currency crisis, but accepted economic stagnation instead. Is that a model the United States could or would follow? The more likely scenario for the dollar involves gradual erosion rather than sudden collapse. Inflation slowly eats away at purchasing power. The dollar gradually loses its reserve currency status as other countries diversify away from it. Interest rates remain elevated as investors demand higher returns to compensate for inflation risk. The American standard of living slowly declines relative to other developed nations. This gradual decline scenario is actually more dangerous than sudden collapse in some ways because it's harder to recognize and respond to. Like the proverbial frog in slowly boiling water, people might not react until it's too late to prevent serious damage. Have you noticed how different the economy feels compared to a generation ago? How much harder it is to buy a home on a median income? How college costs have exploded? How healthcare consumes an ever larger share of family budgets? These are symptoms of currency degradation happening slowly enough that each individual change seems manageable, but the cumulative effect is profound. So, where does this leave us today? The US dollar remains the world's dominant currency, but the foundation supporting that dominance shows visible cracks. Understanding these vulnerabilities isn't about fear-mongering, it's about making informed decisions in an increasingly uncertain economic landscape. Let's start with what's different about today compared to previous currency crises. The United States isn't Zimbabwe or Venezuela. It has the world's largest economy, the most powerful military, deep and liquid financial markets, and institutional credibility built over decades. These advantages shouldn't be dismissed. Many predictions of dollar collapse over the past 50 years have proven wrong precisely because these structural advantages are real and significant. But here's what's also different. The scale of the debt and the speed of monetary expansion are unprecedented in peacetime. The political polarization makes fiscal reform nearly impossible. The country faces demographic challenges as the baby boomer generation retires, putting enormous strain on Social Security and Medicare. And perhaps most significantly, potential alternatives to the dollar system are emerging for the first time in generations. China has been systematically working to internationalize its currency, the yuan. The country has established currency swap agreements with dozens of nations, allowing trade without converting to dollars. China has also launched a digital yuan, positioning itself for a future where central bank digital currencies might replace traditional money. While the yuan faces significant obstacles to becoming a true reserve currency, particularly China's capital controls and lack of transparent institutions, the effort represents a serious long-term challenge to dollar dominance. The BRICS nations, Brazil, Russia, India, China, and South Africa, recently expanded to include several other countries, have been discussing alternatives to the dollar for international trade. While these discussions haven't produced concrete results yet, the fact that they're happening at all signals changing attitudes. 20 years ago, such conversations would have been unthinkable. Did you know that the European Union actually launched the euro partly as a counterweight to dollar dominance? While the euro hasn't displaced the dollar, it has claimed about 20% of global reserves, demonstrating that alternatives can gain traction when backed by large, stable economies. We need to talk about digital currencies, because they represent potentially the most significant change to monetary systems in centuries. But we need to distinguish between three very different types of digital currency, because they have radically different implications. First, there are cryptocurrencies like Bitcoin. These operate outside government control, with supply determined by code rather than central bank policy. Bitcoin's supply is capped at 21 million coins, making it fundamentally deflationary in nature, the opposite of fiat currencies that can be printed infinitely. Some people view Bitcoin as digital gold, a store of value that can't be debased by government money printing. Others see it as speculative mania with no intrinsic value. Whatever your view, cryptocurrencies represent the first viable alternative to government-issued money in modern history. Second, there are stablecoins, digital currencies pegged to traditional currencies like the dollar. Tether and USDC are examples. These combine the transaction efficiency of digital currency with the stability of being backed by dollar reserves. However, they depend entirely on the continued stability of the dollar itself. If the dollar weakens significantly, stablecoins pegged to it weaken proportionally. Third, and perhaps most consequentially, there are central bank digital currencies, or CBDCs. These are digital versions of government-issued money controlled directly by central banks. China's digital yuan is the most advanced example, but the Federal Reserve and other central banks worldwide are researching their own versions. Here's why CBDCs matter. They could give governments unprecedented control over money. Every transaction could be tracked in real time. The government could potentially program money to expire if not spent by a certain date, forcing consumption. They could block certain types of purchases or apply negative interest rates automatically. Advocates argue this would reduce crime, improve monetary policy effectiveness, and increase financial inclusion. Critics worry about surveillance, loss of privacy, and government overreach. The shift toward digital currencies, whether government-controlled or decentralized, represents a fundamental restructuring of the monetary system. This transition is happening now, not in some distant future. Your understanding of these changes will significantly impact your ability to navigate the financial landscape over the next decade. Let's discuss practical implications for individuals. Again, this is educational information, not financial advice. Everyone's situation is different, and you should consider consulting with financial professionals for personalized guidance. The first principle is diversification. Throughout history, the people who best weathered currency instability were those who didn't keep all their wealth in a single form. This might mean holding some assets in different currencies, owning real assets like property or precious metals, investing in productive businesses, or maintaining skills that retain value regardless of currency fluctuations. Consider what happened to middle-class Germans during the Weimar hyperinflation. Those who held only cash savings were wiped out, but those who owned property, businesses, or hard assets maintained wealth. Those with valuable skills could command payment in goods or foreign currency. The lesson is not that you should panic and buy gold. It's that concentration in any single asset type creates vulnerability. The second principle is understanding the difference between nominal wealth and real wealth. Nominal wealth is the number in your bank account. Real wealth is what that money can actually buy. $1 million sounds like a lot, but if inflation runs at 10% annually, that million loses half its purchasing power in 7 years without earning any return. Inflation is effectively a hidden tax on savings, transferring wealth from savers to debtors, and the government is the biggest debtor of all. This is why understanding inflation is crucial. The official consumer price index might report 3% inflation, but your personal inflation rate depends on what you actually buy. If you're paying for healthcare, education, and housing, three categories that have grown much faster than official inflation, your real inflation rate might be significantly higher. The third principle is maintaining flexibility and liquidity. During monetary instability, opportunities arise for those prepared to act. Real estate prices might temporarily crash. Stocks might sell off indiscriminately. But if you're over-leveraged or illiquid, you can't take advantage of these opportunities. Worse, you might be forced to sell at the worst possible time. Have you thought about how much of your wealth is actually accessible during a crisis? Bank accounts can be frozen. Investment accounts have withdrawal procedures. Property takes time to sell. The 2008 financial crisis and the 2023 bank failures demonstrated how quickly liquidity can evaporate. Having some portion of assets in immediately accessible form provides options during turbulent times. Let's zoom out and consider the broader social implications, because currency stability affects more than just investment returns. It affects social cohesion and political stability. Stable currency enables long-term thinking. Businesses invest in research and development. Families save for education and retirement. Communities plan infrastructure projects. This long-term orientation is what builds prosperous societies. When currency instability disrupts this ability to plan, societies shift toward short-term thinking. People consume immediately rather than save. Businesses focus on quick profits rather than sustainable growth. Political discourse becomes more extreme as people seek scapegoats for economic decline. History shows a disturbing pattern. Major currency crises often precede political upheaval. Weimar Germany's hyperinflation contributed to the Nazi rise to power. France's currency crisis helped trigger the French Revolution. Argentina's repeated currency crises have led to political instability for decades. The correlation isn't coincidental. Economic chaos creates conditions where extremist solutions become appealing. The United States has enjoyed remarkable political and economic stability for most of its history, partly because dollar stability has allowed long-term planning and broadly shared prosperity. The erosion of that stability has consequences that extend far beyond finance. Rising inequality, political polarization, declining trust in institutions, these social problems have economic roots that trace back to monetary policy choices. Here's something most people don't consider. Inflation acts as a regressive tax that hits the poor and middle class hardest. Wealthy individuals own assets like stocks and real estate that tend to rise with inflation. They have access to sophisticated financial tools for protection. The working class typically holds more of their wealth in cash savings and fixed income investments that inflation erodes. They have less access to protective strategies. Currency instability, therefore, tends to increase wealth inequality, which fuels social tension. The international monetary system is evolving toward what economists call multipolarity, a world where several currencies share reserve status rather than one currency dominating. This transition could be smooth and gradual, or it could be chaotic and abrupt. Understanding the possibilities helps you prepare for either scenario. A multipolar monetary system might actually be more stable in some ways, if countries hold reserves in dollars, euros, yuan, and perhaps other currencies. Then problems with any single currency don't threaten the entire global system. Trade could happen in whatever currency both parties prefer. Countries would have options rather than depending on dollar-based payment systems. But the transition to such a system carries risks. The dollar benefits enormously from its reserve currency status. The United States can run persistent trade deficits and government deficits partly because the world demands dollars. If that demand diminishes, the U.S. would face difficult adjustments. Interest rates might need to rise to attract foreign buyers of treasury bonds. The government would face pressure to reduce deficits. The American standard of living could decline relative to other nations. Some analysts argue this transition is already underway. The dollar's share of global reserves has declined from about 70% in 2000 to about 60% today. That might not sound dramatic, but it represents trillions of dollars shifting away from the dollar. If this trend accelerates, the effects could become more visible and more disruptive. Gold might play a renewed role in this transition. Central banks worldwide have been buying gold at the fastest pace in decades. Why? Gold is no one's liability. It can't be printed. It has served as money for thousands of years across virtually every culture. In a world where trust in fiat currencies is declining, gold represents a neutral store of value that no single country controls. The most valuable asset you can develop is financial literacy. Understanding how money works, how currencies rise and fall, and how to protect purchasing power puts you ahead of the vast majority of people who never think about these issues until crisis forces them to. Start by tracking your personal inflation rate. Note how much you spend on major categories: housing, food, transportation, healthcare, education. Track these over time. You'll develop a real-world understanding of currency devaluation that official statistics don't capture. This awareness informs better decisions about saving, investing, and career choices. Educate yourself about monetary history. Read about the gold standard, the Bretton Woods system, and previous currency crises. These aren't dusty historical topics. They're blueprints for understanding present dynamics. The patterns repeat because human nature doesn't change. Governments always face temptation to print money to solve short-term problems. The consequences always follow eventually. Build skills that retain value across different monetary regimes. Technology skills, healthcare expertise, skilled trades, teaching ability, agricultural knowledge. These capabilities have value whether you're paid in dollars, WIN, Bitcoin, or anything else. Your human capital is the one asset that can't be inflated away. Stay informed about monetary policy. Follow Federal Reserve announcements. Understand what quantitative easing means. Know what the federal funds rate is and why it matters. This sounds tedious, but these decisions affect your financial life more than almost anything else. The more you understand these forces, the better decisions you'll make. So what have we learned? The US dollar's stability isn't guaranteed by natural law. It's maintained through economic performance, political choices, and global confidence. That confidence is eroding slowly but noticeably. The warning signs that preceded historical currency crises are visible today, though the timeline and severity remain uncertain. Does this mean the dollar will collapse tomorrow? No. The United States retains significant advantages, and the dollar's reserve currency status provides substantial cushion against crisis. But the margin for error is shrinking as debt grows, and alternative monetary systems emerge. The path forward requires awareness without panic, preparation without paranoia, and action without recklessness. The Americans who thrive over the next decade will be those who understand these monetary dynamics and position themselves accordingly. That doesn't mean predicting the future. It means being prepared for multiple possible futures. History shows that currency stability is the exception, not the rule. Most currencies eventually fail or dramatically devalue. The dollar has been stable for most living Americans' lifetimes, creating the illusion that this is normal and permanent. Understanding that it's neither normal nor permanent is the first step toward financial resilience. Your awareness of these patterns puts you ahead of the curve. Keep learning, stay informed, and make decisions based on real economic understanding rather than hope or fear. The currency truth isn't comfortable, but it's necessary knowledge for navigating the decades ahead. If this video helped you understand how the dollar works and why stability matters, hit that like button and subscribe to The Currency Truth. We're building a community of people who want to understand the real forces shaping our economic future, not just the comfortable narratives. Drop a comment below sharing what aspect of dollar stability concerns you most, or what questions you still have. And remember, this information is for educational purposes only. Do your own research and consult with financial professionals for personalized advice. The monetary system is changing whether we acknowledge it or not. The question isn't whether change is coming, it's whether you'll be prepared when it arrives. Thanks for watching. And I'll see you in the next video where we'll explore the warning signs of economic collapse and what they mean for your financial future.